I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. Today's episode is exceptional because in terms of his seniority and the sheer size and global nature of his role, my guest is in a very small peer group. Chris Williams is chairman of international business at the Tokio Marine Group, and that means he helps oversee a business with a $75 billion balance sheet and 44,000 employees operating in over 40 countries. Only a handful of my guests on this show in the last 5 years have a role of such global breadth and depth. An Australian who has worked in London and spent most of his career in the US, Chris is very much a model citizen of the global specialist insurance and reinsurance world that this podcast looks to serve. In the past 20 years, Tokio Marine Group has embarked on a highly successful internationalisation strategy. This has entailed multiple blue-chip acquisitions in countries all over the world. This has turned it from a dominant Japanese insurer with only around 3% of earnings coming from overseas into a global force that already makes around 75% of its earnings outside of Japan, with that proportion almost certain to continue growing over time. Chris joined the group through its 2015 acquisition of HCC. So in many ways, he's the person embodiment of this strategy. This podcast is a great distillation of that Tokyo global plan and where it may be heading next, but it's also a chance to pick the brains of an industry veteran who can combine a 50-year career with a genuinely global overview. Chris's views on the rise of MGAs, the prospects for a renewed M&A in 2025, the best application of AI, the debates over rate and reserve adequacy in the casualty space, and the overall state of the global market are all unequivocally and candidly expressed here. Chris is exceptionally good company, and I caught him on great form in this podcast. He may be one of the most senior executives in our world, but at heart, he still comes across as a genuine, down-to-earth Australian who tells things the way he sees them. The fact that he's seen so much in such a wide and varied career just makes this episode all the more valuable. Listen on, and you'll see what I mean. I guarantee you'll enjoy it and learn a huge amount. Enjoy the podcast. Chris, welcome to the Voice of Insurance.
Thank you very much. I'm happy to be here.
Well, you've been around long enough that I think everyone should know who you are. But for anyone who's listening who doesn't know you, why don't you just give a brief introduction and tell us about your career to date and how you've gotten to the role that you're currently occupying?
Yeah, I'd be happy to, Mark. It's a story that started, believe it or not, almost 50 years ago in Australia. I'd entered the insurance business there, and having been in the business for a couple of years, I, as a very young lad, got shifted off to Lloyd's and worked for 3 years in the Lloyd's market as a very junior broker. But nonetheless, it was a great experience, and certainly seeing how Lloyd's has changed since the mid-70s to where it is today, is that in itself has kind of been an exciting journey to watch. Returned to Australia with my wife, and I moved to North America in 1981 for what was to be a 5-year stint. And here we are, 40 plus years on, still here. So it was a terrific move. We've been here, as I said, all that time. All of our kids have been born in the US, and clearly it has been and will continue to be home for quite some time. Worked in different roles, principally on the broking side initially. Started my own business, which was sold to Willis in 1991. Had been working with HCC as a reinsurance broker for them. They were based in Houston. And kind of an interesting story there in that I eventually became chairman of the board there and was CEO of HCC, a role that I was in until 2015 when our friends at Tokio Marine came along and acquired us. And continued running that business for them for a couple of years. End of 17, early 18, I moved into the role of co-head of international business for Tokio Marine. So I've been overseeing with colleagues in Japan all of the international business since then. And in the end of March, I moved to the role of chairman of the international business. So I'm still very actively involved, but not perhaps quite as much on the day-to-day areas that I previously was. So it's been a fast 50 years, that's for sure.
I'm really grateful for that because I think that probably gives you a bit more time to do something like this every now and again. Well, the podcast has been going for 5 years, and I'm sure I put in lots of requests over this time, and now you've got time. I finally managed to bag you, so I'm really pleased. Were you a reinsurance broker then?
Yeah, and I actually started on the accident health side, interestingly. In fact, Ironically, one of the larger lines of business that we write today is medical stop loss, which is a type of insurance where employers self-fund their medical business. And back in the 80s, there was this real scarcity of that coverage. And ironically, we developed a facility that Lloyd's participated in, but it was predominantly European reinsurers, and grew that business. Fast forward to today, HCC over the years have made various acquisitions of that business and write today a couple of $1 billion of it. I think they're the fifth biggest writer of it in North America. And it is still very much one of the key businesses that we're involved in. But as I said, it was on the A&H area that I started.
Always a good education, because certainly whenever I've been involved in A&H, there's always so much action and always been a really interesting market and very hard, very soft.
Yeah, it is. And it's an intriguing one. I mean, the first job, actually, when I came to the US, we were insuring professional athletes for disability insurance, which, again, ironically, is one of the lines that we're still very big in as part of the group. Associated with that, we provide event cancellation and all sorts of other weird and wonderful products. So it's funny, you get involved in these products early on and they seem to come back into your life.
Well, I suppose a good product is never going to be kept down, is always going to keep growing, isn't it? Because it's serving a real need. And if it's something that you've got real expertise in, the longer you go on, the more expert you get, I suppose.
Yeah, exactly.
So you're chairing Tokio Marine International. Again, for anyone listening, it's difficult, I think. You'd have to forgive all of us outside of your organization to understand exactly how it all fits together. So what parts fit into Tokio Marine International? So what's under that purview in that grouping? And what sort of scale, let's say in premium terms and in headcount, that actually entails? And presumably, I mean, it's almost every country in the world.
Right, it just about is every country in the world. I mean, just to kind of set the scene, as a group, we're at about 75 billion of market cap. So puts us in the top handful of property casualty insurers in the world. 44 different countries that we operate in. Interestingly, about 44,000 employees, and about half of that is overseas. So it's been a very interesting growth that we've gone through, which if you turn the clock back approximately 20 years ago, about 3% of our earnings came from our international business. If you fast forward that today, it's more like 75%. Now, it's not to mean that we've gone backwards in Japan. To the contrary, we have a very dominant position in Japan. But quite frankly, there's only a certain amount of market that you're going to be able to grow there when you have such a strong position. So the strategy that was taken in the early 2000s to go on this acquisition endeavour that we've been on has really been a terrific one. And quite frankly, it's been a very exciting part of my career, having the opportunity to oversee that. I think to your point, there's a lot of people that probably don't even know all of the companies that we own. And we've certainly done a better job in recent years making the world at large who we are. But we have taken this federated model where we let companies basically to continue to trade as they previously had. And so as a result, it's been a little bit difficult for some people to join the dots to work out who's part of our group.
I suppose it's a very Japanese way of doing things. In many ways, it's very respectful of the brands that they have acquired, again, and it tends to have acquired very high quality businesses as well, I would say. Obviously, I look at a business like Kiln, and a business synonymous with being a blue chip Lloyd's business. It's only really in the last few years it started to have TM, i.e. Tokio Marine, initials started to apply to it. It was sort of, very much the brand was left alone and respected. Yeah, it was about 20 years ago. I'm glad I got that about right. It was 20 years ago when the internationalization strategy, and I suppose it's fair to say that the Japanese market was not perhaps growing that fast and the Japanese economy wasn't growing that fast, but also the insurance market had very much consolidated. So there wasn't obviously a way of growing through M&A within Japan. So it was an internationalization strategy. So, well, we're going to have to become a global business and get as much of our income overseas. Now you've got to 75%. Is there any particular target in mind? Could it be beyond 90 or something at some point? Or it's not the sort of thing where you've got a number. I know there was a big deal when you went through 50.
Kickstart your 2025 by attending Tintech London Market and supercharge your digital transformation and operational efficiency.
Tintech London Market allows you to explore the latest developments, innovations, and use cases for technology, Gen AI and analytics in the London market.
And it's not just about the tech. It's about people, process, and technology.
You'll discover insights on developing successful change, building a high-performance culture, and successful implementation of emerging technology.
Join thought leaders and industry experts at the #1 technology strategy and innovation event for the London market.
Search TinTech London Market to discover the full agenda and speaker lineup.
Mark, we've never really had a target per se that we want to get to X%. It's really been as those markets have evolved. And if you look at where we have a very strong presence in the US, as you know, it's the biggest insurance market in the world. We've got a very strong position through our different companies, be it Philly or HCC, Reliance, and Safety National, Pure, Kiln. These are companies that really are very, very highly regarded. And I think it's been important for us when we've made those acquisitions that we preserve the DNA that was in those companies, because Philly was a great business, is a great business because of what they do, in the same way HCC is. And we've all taken the view that some companies, when they do the acquisitions, they try to force everything into the one funnel. We don't think that works. And so it is a little more labour intensive, the federated approach, but I think we get much better results out of those businesses. And of interest, all of those companies that I just mentioned, every one of them is bigger today than when we acquired them. They have more employees today than when we acquired them, and their results have been terrific. And the final part that gives us a lot of comfort is that obviously as time goes on, we get some retirements, but practically all of the senior people that came with those acquisitions are still with us today. And that's a pretty unique statistic when I'm sure you've been around the block a lot, you've seen a lot of M&A, and that doesn't always apply. And we're pretty proud of that.
And so in terms of what you want the world to perceive of Tokio Marine International, is that really something that's more than an internal thing within Tokio Marine to say, yeah, your line on our balance sheet or on our P&L, here's some numbers over here, but really it's actually constituted by a federation of different businesses? Or is there some commonality, something to say, well, Tokio Marine International, should it mean something to a broker anywhere in the world, for example?
Well, our goal is yes, it should. And at the end of the day, we're here for our clients. And as you know, we're in a global environment with businesses that have offices and factories and people literally all over the world. And there are only a handful of companies that do have the capabilities to provide those coverages around the world. And I think by putting together the expertise that we've got, and I'll just use a couple of examples. One of our companies, HCC, have been long-time writers of D&O insurance. Of course, we wrote D&O insurance in Japan, but with the expertise that came with that acquisition, we were able to take some of our D&O experts and put them in places like Singapore or London or wherever it is and offer that to our clients. So we both see it as being able to service the clients that we've have, but also as we hopefully acquire new clients, that we can say, yes, we've got this selection of product that we can offer in just about any country in the world. And again, there's not a lot of us that can do that. I mean, some of them are specialists in particular countries or specific areas, but we feel as though we've got a great suite of products that we can offer our insureds.
So when you're saying to that client, you can say, actually, a lot of this is very joined up, even though you can see that there's a federated approach to some of the brands, that you want to have that group to be much more integrated, much more sort of borderless within the business. So if you're an employee, for example, you feel that you could ask for a transfer to Singapore or London or Houston or New York or wherever you wanted to go.
No, very much so. And I think one of the great things that our colleagues in Japan did early on is that as we make acquisitions or indeed acquire or start businesses, we've put expats in each of those offices. So it makes it so much easier that, as an example, if a client, I'll go back to event cancellation, is in Brazil and they need some event cancellation there for whatever it is, the expat in the Brazilian office will know the expat in wherever we happen to be writing that business out of, be it Boston or London or wherever. And so whilst the businesses are federated, there is clearly interaction there, which I think has been very, very important to what we've been doing. So it really does make a very seamless approach, if you will, as clients want to, or brokers want to purchase a certain coverage somewhere in the world.
Tending over time, it's likely to become more public-facingly a Tokio Marine offering globally.
Yes, it will. You raised an interesting point before about the fact that Kiln has Tokio Marine in its name now. That was at the insistence of Kiln. That wasn't at the insistence of Japan. And likewise, when we've made acquisition, and when I was CEO of HCC, my view was that HCC had good name recognition in the US, but it was really not known outside of the US, even though we had quite a strong international presence, which today is very significant. So from day one, we took the view that we wanted Tokio Marine in the name. Philly, still trade as Philly, a Tokio Marine company. So there is certainly the connection there. And of course, we have governance and oversight and all the rest of the things that you would expect with a company of our size. But I do think having them operating as they are is part of our secret sauce.
So you're trying to get a best of the both worlds type situation.
Exactly.
Have all that strength, but at the same time have all the individuality where that is a differentiator.
Yeah, and if you look at the economics of it, when you go from operating a business, in HCC's case was $5-6 billion. Now you're working off a $75 billion balance sheet. You tend to get people's attention a little bit more.
And obviously that has a large amount of capital efficiency at that group level.
Very much so.
With your diversification, it must be about as good as it can be.
We do have a very diversified portfolio of products, and that is, I think, part of the success that we've had in putting these businesses together. We've got terrific diversification. I mean, when we were basically a mono Japanese company, our results would ebb and fall based on whether you had storms in Japan. The flip side of that is that if there's an event somewhere around the world, chances are we'll pick up a piece of it. You obviously hope that every country doesn't have some event at one time. But even if you look at COVID, I mean, we managed our way through that. Ourselves and other carriers obviously had fairly significant losses from that. But again, we've diversified enough around the world that we still produce very solid results through that period.
So as you're surveying your world, 44 different territories and all the different classes of business, it would be impossible to list all of them. Where are you most happy? Are there any parts that you can single out, your budget for next year or budgets when you're going through this budgeting process and board meetings, etc.? Where are you happiest prospects for profitable growth at the moment?
I think it falls into two categories. In terms of developed countries, we are a very strong specialist insurance company. So select the more challenging lines of business. We believe that we've got the expertise within the group to write those businesses. So we also are aware that it's very difficult to compete with domestic companies in various parts of the world. They've obviously got a very strong hold there. But in the specialty lines of business where we have expertise, that's where I think we shine best. For the developing countries, it's more the traditional personal lines business, perhaps some commercial business. And as those economies evolve and they become more sophisticated, we think we can take the specialty businesses in there. But at the moment, as they're developing, it's kind of early days for that. So they're the two buckets, if you will, that we look at as we develop the business.
Well, I suppose the last few years, the specialty side of things has really done very, very well, I presume. You must have grown a lot.
We have. And I mean, if you look at the results, I mean, we are very, very bottom line focused versus top line. But I think we've been able to grow the business at a very respectable rate and still running in the low 90s combined ratio, which is a pretty impressive number when you consider a lot of the events that have occurred over the world over the last 4 or 5 years.
And in terms of the outlook now, is that growth likely to be a little bit more tempered, a little bit more modest? Certainly the rating outlook seems to be starting to stabilise, whilst it's still in a very good place in terms of rate adequacy. But in terms of just pure top-line growth, is it right to say that it's likely to be more modest?
I think that's right. I think, as you know, in this crazy business, probably the easiest thing to do is grow the top line, and inevitably that doesn't end well. I think we're seeing, and it's quite topical, I've been in New York for this week and meeting with several other CEOs, both of insurers and reinsurers. And I think the view is on the property side, certainly the rate of increase is slowing with potentially some downward pressure. But as we know, the last 2-3 years have been extremely good for reinsurers on that front. Casualty side, a little bit different story. I think the results of casualty business, as a general comment, have been challenging. So we're not seeing rate reduction there, and in fact, probably hardening. And I think, interestingly, reinsurers are probably pushing terms a little hard on the casualty side in terms of ceding allowance and what have you. So I do think things will start to slow a little. But again, some pockets will still continue to see some upward pressure.
Yeah, I should lean on some of your long experience with HCC, being such a well-known casualty player, particularly in D&O. How are you feeling about yourselves and your own appetite? The great thing about casualties, of course, is everything is always debatable because it's such a long tail. It's difficult to know where you are. The best people always have a better view, so have a better kind of periscope than other people. Your view would be valuable to me in terms of where you feel that particularly US casualty pricing and reserving debate is at the moment.
Well, I think you hit the nail on the head. Casualty business is a long tail business. And insurers and certain reinsurers seem to become intoxicated with the premium that's being collected and probably too aggressive in their reserving or the lack thereof. It's not to say you get every program right every year, but I think our reserving philosophy has held us in very good stead. It may mean that you're perhaps not clipping quite the margin that you think early on, but long term, I think that plays out very well. When you see companies having to put up significant reserve increases, and it's not to say we haven't had to do that on certain accounts, but as a general comment, that's not been an issue for us. So I think when you start on casualty business, you need to understand you're in this for a while. This isn't something that you write it today and then you get to the end of the year and say, well, how did that work out? I mean, it's 7-10 years longer, depending on the line of business. What I like about our portfolios, we do have an element of long tail business, and I think we've managed our way very well through that. I'd mentioned earlier in our conversation about medical stop loss. That is a very short tail business. That is a line of business that 12 months after, you know whether it's win, lose or draw. So again, I think it goes to the construction of your portfolio. You want to make sure that you do have some long tail there, which obviously comes into the investment income side of things if you're sitting on reserves for extended period. You also need a balance of some shorter tail businesses so that you can see perhaps a little faster where you're sitting in the scheme of things. So I like where we're positioned. I think the US casualty market is going to stay under pressure. I mean, social inflation is still steaming along. We still have some very aggressive courts. But that, as you know, and you've been around, that tends to ebb and flow a little bit with the politics of the time and depending on how aggressive the courts are or whether there's any tort reform in any particular state.
Do you think there's a penalty to occasionally having to increase reserves, penalty from investors, but there's also premium from investors as to being the guys who don't surprise, the people who come in steady? Do you think that premium's worth more than the other version where you look more profitable, but occasionally you get the penalty?
I would far prefer to take the premium and put out what we believe are the best numbers up, that are conservative numbers, in the same way that individuals don't like surprises, our shareholders don't like surprises. And so if we can manage our portfolio so that we're making our best estimate as to where we think the reserving will be and not surprise them, that keeps you in very good stead. And again, having run a public company, I would far prefer to go down that route rather than coming along for a couple of years and saying we've blown the socks off things, we've had unbelievable results, and say, oh, by the way, we've got to increase reserves by X, millions. So I think it's a far more prudent way to run the business.
I suppose because you're so global, you're so diversified, that if you maintain that kind of conservative philosophy, you're far more likely in the aggregate every year to be able to release some reserves.
I think that's right. If you go back and look at historically how we've performed, I think that comment holds up.
And the other question is also, who would you rather buy insurance from? As a broker, or a broker recommending their customer, stay with these guys, their price is their price, but you don't tend to get any surprises and their appetite's also consistent.
Well, there's a reason we've been around for 145 years. We want to be around for another 145 years. And giving the market shocks periodically with big reserve adjustments isn't a good way to win friends and influence people.
No, absolutely. So I would take it from that. That's probably a message from you that your appetites are probably fairly consistent. It's not as if you're suddenly going to put your foot on the accelerator or put your foot on the brake. You've got your view and it's a fairly constant one.
It is. And if you look at certain lines of business, just to stay on the casualty for a second, I mean, the results obviously ebb and flow somewhat as to what the market will give you. But I think the big variable with us is there are certain lines that we will write significantly less business in certain years, rather than saying, gee, we've got to maintain this top line because it's going to create expense issues or whatever. Provided the market understands that and knows that we are actually focused on what's happening on the bottom line, I think we would get rewarded far better for that than saying our gross premiums increased every year over the last X number of years. I mean, it does because we bring on new products and buy new businesses and what have you. But there are certain lines of business that you'll ebb and flow because the market's just not giving you the terms and conditions you want. I would far prefer to make a little less money in a really soft market. And then as things change, you may write more of it. Or said another way, you might lose less money in a soft market if you've actually pulled back the writings.
I suppose that's another part of the inexorable logic of being global, having the scale that expense is never really an issue. You know, you never have to take a view based on the fact that I employ X number of underwriters over here. You have capital and you can deploy it where you believe it's most likely to give you the best returns.
That's correct. And I think, as you know, one of the very pleasant things that I found from running a US public company to becoming part of a Japanese public company was they take an incredible long-term view on things. And I remember back in HCC days, we would have a fantastic quarter and the analysts would say, well, that's great, well done, but really what's going to happen next quarter? And you'd get zero time in the sunshine for the good results and they wanted to know if they're going to keep continuing. I think we are certainly regarded as a company that takes a long-term view on things. We have planning groups that go many years out into the future. And I do like that because I think this is a business you can't live quarter to quarter. You've got to have a lot longer horizon to make sure you get it right and grow it appropriately.
Looking more at the immediate future, you mentioned about perhaps a little bit more pressure on some property lines. And in the US, obviously, hurricane exposed lines, it was anecdotal that the pressure was building, particularly in those mid-year renewals. And now we've had hurricanes Helene and Milton since then. Do you think they have taken the edge off any pressure for rate reductions?
Perhaps a little. And I was looking at the earnings results of our peers about a week ago. Some of them seem to have outsized losses for their sides. Some of them seem to be pretty much in check. I mean, I look where we are and in terms of our cat loads, I feel as though we're within those around the world. So I think some may be seeing some increase if indeed they did give the market an outsized loss. Certainly from where we're sitting, we did not do that. I mean, the Maui fires were obviously a tragic event. That was a fairly significant loss, but unfortunately that was over a year ago now. But I think we've managed our way through that quite well, and I think we will see, because a lot of the contracts are 1-1 renewals, but I'm anticipating that we're more likely to see flat to down a smidge.
So it's really taken the edge off if there was any kind of clamour for bringing that down.
Yes, I think that's right.
Looking at this overall slightly flattening, but flattening from a very nice place that we managed to have got to generally, it appears in rate adequacy. Obviously good results, now consistently good results over time. If that flattens, there's a bit of speculation, perhaps from some of my colleagues, some of the analyst community, that as things flatten, that might make it more propitious for people to grow via M&A, right? Inorganically rather than organically. I suppose it's just the logic of life. I'm either as a journalist writing about everyone growing because the market's great, or I'm spending most of my time writing about companies taking each other over because the market perhaps isn't quite so great, or that it's a good time to sell. You're probably on the list of every investment banker. You're probably at the top of their Rolodex in terms of who they would call if they were looking for someone who might be a potential purchaser, and obviously an excellent purchaser, prospective purchaser of businesses.
Yep.
What do you make of that thesis in terms of M&A might kick off a bit more next year?
Yeah, I think that thesis holds water. I mean, if you look at the active periods of M&A, it's generally when we're in a soft cycle. And it's generally companies that may have look pretty clever when terms and conditions have been strong, as they have been. But as those terms and conditions deteriorate, they may not quite have the balance sheet to handle that. So do I think there's going to be a rush to M&A over the next 12 to 18 months? No. Do I think companies are looking at perhaps a little bit more seriously? I think they are. It's been interesting since the election in the US and the incoming new Republican Party. It certainly put a little tailwind into the business community in general. And I think the activity that we've seen, or the talking of the activity, has increased. Whether that translates to transactions in 2025, to be determined. But I do think, as a general comment, your thesis is right. The most important thing to us, quite frankly, is just maintaining your discipline. I mean, we do have an appetite. We are an acquisitive company. But in the same way, it's easy to grow a top line of insurance company and then you've got to suffer the consequences. It's pretty easy to overpay for something and then suffer the consequences. So we are very specific about it. I think we have and will continue to be very disciplined about it. We would love to do a transaction. If there's something that came along that we thought was going to complement our portfolio, we'd love to do that. But again, it will be very deliberate about it.
I suppose the best properties rarely come on the market, and you know which ones they are, and you know you need to kind of be ready for when they come.
That's right. And I think to your point, we are, I think, just about on everyone's Rolodex that if that property is becoming available, that we would certainly get a chance to have a look at it. I mean, even the transactions that have occurred over recent years, we've seen, I think I can say, just about every one of them. And for whatever reason, we haven't pursued them. So watch the space.
Well, I mean, you'd be on my list because I know you can execute and yes, and you can pay a good price. You can pay a very fair price and a full price because you can amortize that over a far longer period. If you buy something good, it's never, ever going to upset you, is it, in the future? And it never looks like you overpaid.
Yeah, I often use a real estate analogy, and that is our view is we would rather buy really good houses that don't need to be fixed up. You buy a discounted house, you spend as much time remedying it and getting it right. So we would rather, obviously they've got to have a good financial track record. That kind of goes without saying. It's got to be a sustainable business. But I think the most important part, which is another reason we didn't do much over the COVID period, is the cultural fit. As you know, during COVID, it was almost impossible to meet with people unless we could eyeball them, have a conversation and see what their philosophy is in the business. It was very difficult to do anything. So the window was basically closed while COVID was going on.
Talking about big picture stuff, things that have changed and where a lot of growth's come in the last few years has been a big increase in volume of business coming through MGAs. And obviously you're bound to have seen this. You have such great visibility over the world. I want to get your view on it. Do you think it's a permanent change in the structure of some of the way that business flows around the world? And also, is some of it cyclical? It might flow in and then flow out again.
Yeah, you just took the word right out of my mouth. I do think it's cyclical. We support a number of MGAs. Our friends at Kiln are very big supporters of delegated authorities, and we've had a very good track record with that business. I think there are a couple of points I'd make. I think when the market is soft, MGAs traditionally have a bit more of a struggle. You know, reinsurers may not be quite as willing to give capacity out there if the terms and conditions are pretty tight. In a hard market, such as we've gone through, MGAs proliferate. And, you know, they will claim they've got a different mousetrap and they exploit that. Reinsurers are willing to support it because they're getting healthy terms and conditions. It's also of interest been a very good avenue for M&A for us. And we historically, if you look at HCC, they've done something like 60 or 70 transactions. And a lot of those have been MGAs that we'll take them on. We will quite often leave them on the paper that they're on. We would likely sit behind it and take a reinsurance position. Once we've got comfortable with the business, we roll it onto our paper and retain it all or buy a lesser amount of reinsurance. So the MGA marketplace is something that always intrigues us. They are, I think as a general comment, some of them quite innovative in certain products, but you need to make sure that there's value added. And then to go back, as I mentioned before, you've got to make sure there's a cultural fit there if we do bring them in under the fold.
So do you think some of it would flow out again as the market softens?
I do. I think you'll start to see a bit of contraction in that. I mean, even if you look at the prices of some of these ones, which were going for very hefty premiums, the pricing seems to start to be making a bit of a downward move as well. So that, to me, is another sign that it's probably softening up a little bit.
What about some of the more secular arguments? Yes, you mentioned those reinsurers, and over our careers, well, over your career, even a little bit longer than mine, but over that time, we've seen reinsurers access, I suppose, insurance is globalized, and obviously Tokio is part of that. You're a total manifestation of insurance globalizing, but obviously all your top 10 global peers have done similar things, some of the European ones, etc. And the way that you access the reinsurance markets changed, whereas Tokio or Allianz or AXA or a large global insurer 30 years ago might have still had 180 different treaties. And now they've rationalized all that down either into Trieste or to Paris or to Tokio, where you're bringing that into an internal reinsurer and then you're buying a massive retro out of the back. And that's great for a large reinsurer, a global reinsurer like Munich Re. They said, well, this is quite efficient, isn't it? Who wouldn't want to write that fantastically diversified book of business? But for some of those medium-sized reinsurers, I suppose they're effectively, over that time, they were being asked to take on more volatility than they were before. They're just there for the volatility rather than having some of that, what others have described as, let's say, ballast business or business that's far more stable, low limit, insurance business by any other name, that they're writing on a proportional basis, and something that runs along nicely and bumbles along at 99 forever, which is a great thing. And that they don't have that business anymore, and therefore some of these hybrid carriers and that way of accessing the MGAs is a good way of getting back some of that access to business that they lost. Do you think that's fair?
I think that's a fair comment. I mean, the other point that kind of validates your thesis there is, before we started on the acquisition trail in the early 2000s, we'd formed Tokio Marine Group, which is a reinsurer in Bermuda. We established in the year 2000. And it was done with one reason and one reason only. We did not have the diversification. We were a Japanese company. And as I said, we basically stood or fell based on what was happening in that market. Fast forward 10 plus years, 20 years, we obviously picked up that diversification by buying all of these companies around the world. And we made a very strategic decision that was capitalized around $1 billion plus or minus. And the strategy at the time was, do we really want to deploy a lot more capital into that and become a significant reinsurer along the lines of what you're talking about? Because our view was at $1 billion, you weren't going to be able to really add a whole lot to the equation. So we took the view to sell that business to RenRe. They've done a terrific job with it. They're a great partner of ours. They are still a big reinsurer of ours. But we basically concentrated on what we do. If you look at our competitors, our peers, the ones that we really rate quite highly, the vast majority of them, they may have a reinsurance account that they write, but it's very small.
Yeah.
And I think they're electing to focus on what they're good at, which was certainly the view that we took. As a result of that, then it does tie in exactly to what you're saying. I mean, we have centers of excellence, obviously, in Japan for our reinsurance. We also have a center of excellence that sits in London. We've got experts there that can work on our worldwide programs. And to your point, reinsurers love the idea of getting a diversified program that is not simply on North America or Japan or wherever it happens to be. So I think perhaps the smaller reinsurers may be forced to stay on the MGA bandwagon for a while, but it generally doesn't end too well. We'll see how it all goes, but that's kind of how we've got to where we are.
This is another big picture question. We've got lots of interesting new classes of business. We seem to be in a really innovative time. Certainly, I feel very privileged sitting in London at the moment with fantastic insurtechs, the Lloyd's Lab. There's all sorts of really smart people attracted into insurance at the moment, and they're getting a good opportunity to sort of try out new things. At the beginning of my career, certainly cyber wasn't really a thing yet, and D&O was the glamorous, the fastest growth class, I would say. It was the one sort of, you grab that tiger by the tail and that'll look after your career for the next decade. We've had cyber, has been a similar sort of growth story. We've got a lot of interesting new classes of business emerging at the moment. Which ones are you most excited about in terms of being the next cyber or being the next D&O?
Yeah. Look, cyber in itself, as you know, that's kind of gone through a cycle. I mean, everyone wanted to write cyber and it was the new darling of the street. And of course, when that happens, the pricing comes down, terms and conditions get expanded, and surprise, surprise, and losses start to appear. So That market to us seems to be correcting itself a little bit. I think insurers are being more responsible, and I think they're also being smarter on terms and conditions. I think where we're spending quite a lot of time is just on the whole green transformation and renewables. We, over the last 4 to 5 years, have been hiring different teams for different areas of renewable energy. Obviously, very forward of mind to just about everyone that's in the insurance business, but just in business in general. I mean, I think we've all been a lot more responsible about that side of things. So we're putting a lot of effort in there. We obviously have the benefit of having some very long-standing Japanese clients that we work closely with. We did an acquisition a few years ago called G-Cube, which specialty is on renewables. Yep. They obviously have offices around the world. So we're spending a lot of time on that front. And I think the coverages that are going to come out of that, you might be running credit insurance as an example for some of these projects. But the dollars that are involved to develop some of these alternative sources of energy are very, very significant. So we see that as a place that we're putting some effort in. We've got a global initiative underway about it. In fact, this week here in New York, I've had a series of meetings on the topic. So I see that as an area that I think is going to require a lot of expertise. Not that cyber is a straight vanilla product. It requires expertise. But I think when you get into some of these renewable areas, they are very, very complicated, expensive projects, and they're going to need some very significant risk management as we work through it.
Yeah, and some of these are quite long tail. If you're talking about the efficacy of a battery storage facility, for example, that kind of thing, you suddenly think, well, yes, these are things that require a lot of expertise, a sort of sharp intake of breath.
Yeah, very much so. Very much so.
Excellent. So, well, it's good to see that is something you think it's a big thing for the future.
Yes, very much so.
Something else, I mean, very much of the moment and the future is AI. You've got a large visibility, all those different companies around the world. And obviously, every technologist is coming to you to present to you what is the best whiz-bang that you can use AI for. Of the ones you've seen, what do you think the best use cases are within your organization?
You're absolutely right. We get a presentation every hour of the day from someone giving us some kind of the new mousetrap. But the greatest asset that we believe we've got are our people. And that is an asset that we are very, very anxious to maintain. To the extent that AI can help supplement some of the things they're doing, that to us is a good use of AI. It is not something that we take the view that we're going to be used AI for and therefore, eliminate a whole lot of people and what have you. That's not where we believe we can go. And then the other part, and it kind of goes back to my conversation about the specialty businesses that we're involved in. These are generally very technical businesses that require individual underwriting. If it was a straightforward auto quote that put the information in and it'll spit out what the premium is, I see that in certain areas that could absolutely be beneficial. But I think it's a mistake for an insurer to take the view that AI is going to be the silver bullet to do everything we can. Because clearly we can do some things more efficiently. We're not surprisingly spending a ton of time on it, but it goes back to a conversation you and I had at the start of this, and that is at the end of the day, you want to make sure that you're not inadvertently putting out a whole host of confidential information, that you're trying to develop something and all of a sudden, because you've accessed into some generative AI program, that now all of a sudden your information's all around the world. So are we investigating it? Are we using it in parts? Yes. But again, I want to highlight that we still think that the biggest asset that we've got are the people that get in the elevator each night. And we hope like hell they come back next day.
So it's more about allowing them to focus on, get rid of the boring stuff for them and allow them to be more productive and to add more value, and therefore they'll be happier and presumably be able to afford to pay them then as well.
I'll just give you one example. I mean, policy filings in the US, as you know, are a state-by-state filing. Unfortunately, there's not one federal filing. Just about every state has some different quirk in it. To have an AI program that can identify that for us, to say that make sure if you're riding in California that this provision is included. Of course, we've got manuals and people that can do that. But to the extent that that can be handled by AI. We still need the individual there putting the information in or pulling it out. But that to me is something where we could be quite efficient. So those things I see it being helpful.
Or if you're a property underwriter, there's a huge property program comes across your desk and the AI has helped to summarize 150 different inspection reports and highlighted things. They think, well, you should look at this. I think, obviously, you need to understand them. Or again, I've seen applications for claims files. Again, you get a claims file, and obviously perhaps in some of those medical claims files, they're huge. And again, if they could summarize some of that information quickly so that you can make a decision about which one's top priority, for example, then I mean, it doesn't stop you doing your job or adding your value, because you still have to decide what to do with the claim and how to handle that claim, whether to fight it or to try and settle it or whatever. But it's going to make you more productive. It's going to make you be able to handle more.
Absolutely. And you need to be able to develop what that metric is. I mean, the AI, they may be able to say, look, we've noticed that in this particular county, the prevailing courts there are giving outsides awards. That would be interesting information if you're running business in that particular county. So there are some things there that I think AI will enable us to pull that information faster and more accurately.
And that's from third parties as well as your own book.
Exactly.
One last question is, it's going back to the beginning of that theme about this big family of businesses that you're part of and that you're overseeing. It's amazing, it's one of the most global and the most multicultural enterprises. How do you go about fostering a sense of a shared community and culture so that people say, look, I'm a Tokio Marine person?
That's a really good question. And it's something that I think as a group we've really, made some significant strides in. And when you bring a company or individuals in that they've got a culture, they've come from whatever environment they're in. I think as a group, we, over the last 5 years, have made significant strides to get people on the same page. And one of the interesting things that we do when we do acquisitions, one would think that you'd sit down there and you'd say, well, where are our synergies? Where can we make this bigger and better? That's not really a consideration that we take into account. Our belief that synergies need to come about because you're running a business, I'm running a business, you and I should be having a chat saying, what can we do together that's smarter for us to make it bigger and better? If you look at those synergies today, I think it's $600 or $700 million that we contribute to our bottom line as a result of some of those synergies. They come about because you're all on the same page, you're thinking about the businesses the same way. We do have a mantra to be a good company, and that does mean being a good company for our clients and for our employees. And I think we've got that message across. And I think it may be one of the few side benefits of COVID, but I think when COVID started, it forced a lot of our colleagues, obviously we weren't running around the world seeing them, but to have more interaction, to swap notes about how are you handling business interruption claims in England versus business interruption claims in the US or whatever. And that dialogue increased significantly. We've just finished one of our CEO meetings here in New York this week, and there is a real sense of community with all of our leaders. So it's hard to quantify that in a few words, but I think we've got a very cohesive people that are all singing out of the same book.
That's very interesting. That's a real actual illustration of a difference in culture, isn't it? That's a real difference. For example, with the synergies, when we see we say Anglo-Saxon capitalism is the way that a lot of people describe it. You see a deal and on the first line is X amount of synergies and start talking about the run rate and all this stuff. Whereas I presume on the Japanese owned deal, you're expecting those synergies to come at some point, but that's not why you did the deal. And also you expect the synergies to come in a more organic way. We've bought this company and that company, so they're likely to start doing things together, and therefore that will probably be more efficient.
If you look back at the announcements of all of the transactions we've done, I don't believe you will see the word synergy mentioned anywhere. And it's exactly as you just described it. It is something that we believe that needs to come. When I go back to my broking days, I remember certain companies that say, well, we've got ABC company here doing their insurance, but we should be doing their reinsurance as well. And of course, the broker that's handling the insurance is saying, well, I don't want to do that because I don't want you to mess up the relationship. And the reinsurer is saying, well, I don't want you to do that because you mess up the relationship. It's got to be a natural thing that comes about. And I think when you get respect for people, when you have success at doing it, it grows on itself. But it is a very important point. You will not see the word synergy used when we do acquisitions, because we do believe it's something that just naturally needs to come about.
Yes, I suppose the thing people always forget about insurance is that it takes time and it takes some to build up trust. You're entrusting the survival of your company to a reinsurer effectively, or to a panel of reinsurers, and the same, a client buying insurance from a big panel of insurers as well. The same thing. They've got to have that faith that they're going to be there for them. And you can't just suddenly disrupt those things if those are relationships that have built up over long periods of time.
And look, an insurance company shows their true value when the loss occurs. I mean, we are providing a balance sheet protection in the event of a man-made event or some natural catastrophe. But if you look at, it's one of the things I was so impressed with when I first became part of Tokio Marine, looking at how they enact after an event that occurs there. I mean, they literally take a building as near to the catastrophe as possible. They will ship people in there the night of the event or as quickly as they can get them in there. They will start providing service to these people. They'll start providing claims assistance to them. It really is a very thoughtful process that they go through. And it's one of the reasons we have such a dominant position in Japan. We need to make sure we're doing that around the world. And I think as a general comment, we're getting better and better at that we are there to respond in the event of some sort of adversity.
Chris, thank you so much for your time. I've really enjoyed talking to you. It's been really all-encompassing conversation. I hope I haven't taken up too much of your time, but maybe I've given you a break from all the other things you have to do. So thank you so much for your time. I've really, really enjoyed talking to you. It's good to see a big smile on your face as well.
It's nice to see you as well, and I look forward to catching up with you at some stage in the future.
Absolutely. Thank you so much.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out.
Before we go,
Just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.